Hey everybody, this is Ryan Mallory with SharePlanner.com, and I am going to do a mid-afternoon update here for you guys and go over what it means to deal with price action around the 200-day moving average, because the reason why I've been doing so many videos about the 200-day moving average is because the market activity really picks up when there's a lot of support there at the 200-day moving average, like what we've seen of late, and you can see some really big whipsaw activities. Now, a lot of times people tend to look at the stock market and say, if it's trading below the 200-day moving average, it's bearish. And if it's trading above the 200-day moving average, it's bullish. But that's not really true. In fact, a lot of times the market will purposefully go below the 200-day moving average just to suck in the short sellers, just so it can squeeze them to the upside later on. And that's what we're seeing today. If you look at previous tests of the 200-day moving average, going back to the February lows here of 2018, you have a test here where it broke below and then it immediately shot up. And then here back in April, you had another test and it actually closed below the 200-day moving average, but the next 3 days it squeezed higher. And if you even go back a little bit before then, on March 23rd, we test the 200-day moving average, immediately pop up. So a tested 200-day moving average doesn't necessarily mean that the stock's going to break down or that the ETF or the index is going to break down. And even more so, just because it breaks below the 200-day moving average doesn't mean it's going to keep selling off thereafter. So I'm giving you plenty of examples here. April 6th, the same thing. After it tested April 6th, it was a good couple of week rally there. We tested it again in late April, and now here we are in May. We broke below it today, and when all hope seemed to be lost, like we were just going to keep selling off and moving lower, the market bounced right back up again, and at some point today, it's actually been green. It's flirting with it. It's down 4 points right now, but it's been going back and forth between red and green throughout this afternoon. So strange price action takes place at the 200-day moving average. So then the next question becomes is, well, what am I looking for to play a possible bounce off the 200-day moving average? Well, first off, you need to see it in the charts, okay? So I'll pull up this 5-day moving average here, and it's these lines that are going across. These are pivot points. For right now, you can ignore it, except for the fact that the S&P touched that S3 support level perfectly today, and we see that a lot of times where it'll touch it and then it'll start pushing back higher, and that's what happened today. So once I saw this base, and I'm going to eliminate some of the price action here. When we had this sell-off here, okay, there's no price action that's favorable for the bulls here, okay? Right here, you start to ask yourself, okay, are we going to bounce? Are we starting to form a base here? It's possible because it's right around this S3 pivot level. And then you start seeing, okay, this is a possible cup and handle pattern. You have the cup, you have the handle, and now we have a breakout. That's where you start saying to yourself, all right, the thing's going to rally here. There's a game change here where it's reversing course from the morning and it's going to push higher. And then you get this initial pullback, and this was important too. Actually, I would even go back and say this little 15-minute pullback was also important because it could have easily have gone back down to the lows and established new lows on the day, which does happen from time to time. But it didn't. Instead, it saw the buyers come right in with full force and push this market higher. And then it did the same again. It tried to retest it a little bit here, but it continued to rally higher. So overall, this has been some pretty good price action for the bulls today. And even though it flushed out traders early on, it managed to stabilize and give you a good dip buying opportunity. So then what stocks did I go after? Well, I'm looking at the sectors that are going to be doing the best, and one of them right off the bat at that point in time, I didn't have any technology, but if you look, technology is one of the 4 sectors today that are trading in the green. I've stayed away from staples because I think that's a little bit of a loose cannon right now. It's much more bearish over the last few weeks than any other sector, so I'm not going to trade that even if it is bullish today. I just don't trust it quite enough to buy anything long. You can make a case for industrials. I have like some of the price action in the industrial sector today, but and you could see here on the 200-day moving average, it's testing it. So if I was looking for that, look at the price action in Boeing. That's a pretty good bounce off the lows there. And you have a trend line that's formed off of the, I guess it's about the March lows. That's held up pretty well, and it held up again today. So that was one of them that I was considering. But what I did is I didn't have any I didn't have anything tech in my portfolio. I had Netflix, which is kind of tech, but I consider it more discretionary or consumer cyclical. I had HES, which is oil. So I had those two represented, but I didn't have any tech, and I needed to do that. So I went for Salesforce. Now, why did this one stick out as much as it did? Well, for one, like I said, the tech has been one of the best industries of late. Yes, it has that glaring head and shoulders pattern, but if you look at something like Q, you can see here, it's nowhere near the 200-day moving average. It's trying to break this declining trend line. So the declining trend line on SPY is very far off, but on QQQ, it is not. So there's more of a bullishness to this one that could play out in the near future. And then when I look at some of these stocks here, and I was noticing it across the board on the tech stocks, that your software industry was doing quite well relative to all the other ones out there. So if you pull up like Splunk, for instance, it's breaking above it. Now, when I got into CRM, it wasn't breaking out, but right now it is, so that makes it a good trading opportunity. But if you just look at all the green here, okay? Now, the market's still red as I'm trading right now. But all the software stocks, they are very bullish. Autodesk up 2%. Now, up 1.9%. You have Adobe up 2.3%. So there's a lot of bullishness in this sector right now, and Salesforce was the one that had the best trading opportunity because you had this declining trend line and it was breaking out of it, and that's why I got into it. So here's the thing. You got to make sure that the market's basing first, and then you got to make sure that that there's some kind of breakout that ensues thereafter. Then you got to find the sector that is looking the most bullish, or the group of sectors that are showing the most strength on this market bounce, and then find the industries within that sector that you're targeting that's showing the most promising trade setups. And in this case, it was software application, and that's why I got into CRM. And looks good still, did pretty good for us, and I'm excited about where it goes in the future. With all that said, I'd encourage you to go over to sharepointer.com. Check out the free trading course, Patterns to Profits. It's really good. It's really helpful. It'll help you identify a lot of these patterns and which ones that you can target. And highly recommend it. Once again, it's free. It's about 3 extra hours of video course tutorials, and it's laid out in a very simple and explanative type of format. So go ahead, download it, and hope the best for you in your trading.